Welcome to Real Estate Financial Modeling's comparative lease analysis from both landlord and tenant perspectives. The goals of today's session are to first understand what the major variables are in commercial real estate leases, next to understand how they differ from the perspective of the landlord and tenant across the different major lease types. Then we'll run an analysis in Excel from both perspectives and then compare the results. The major economic variables in a commercial real estate lease, first and foremost, we have the space itself that's being considered and the size of the space, and then also the physical condition of the space upon its delivery to the tenant. The picture here shows basically an unfinished space, or what some people call a plain white box or a vanilla space. Basically nothing on the ground. The ceilings are finished in sort of an industrial manner, so I guess you could consider the ceilings to be finished if that's the look and feel that tenants would accept. Next, in terms of variables, are the lease length or the term of the lease, and then the costs to operate and maintain that space and the costs to rent the space to the tenant. Some examples of operating and maintenance costs that are incurred by the landlord as a cash cost, whether this space is occupied or not, are electricity, water and sewer, cleaning, repairs and maintenance, lot landscaping and trash as it relates to the overall property, and that particular space's pro rata share of those property-wide costs, security, general and administrative, management fee, insurance, and real estate taxes. All of these costs will be pro rata to the size of the space in question. When we take a look at these variables, we start to see some differences. Well, for the lease term, naturally that's the same to both the landlord and the tenant. With respect to the costs to operate and maintain the space, these are often shared between the landlord and the tenant, either through reimbursement of expenses from the tenant back to the landlord and or through direct billing of those expenses from the various vendors and service providers and utility providers to the tenant. And the costs to rent are therefore going to be impacted by the sharing of the costs to operate and maintain the space. And so it's here where things start to get a little trickier as it relates to modeling these commercial leases of these various types. And this is where the nuance comes in, and this is where we can assist you and add value to your daily workflow in terms of being able to, first of all, get to some answers quickly and then get to more precise answers using more advanced, sophisticated tools that we offer. The first thing to keep in mind is every lease is going to be unique with respect to how these operating costs are accounted for, which are included, which are excluded, how they are shared, and so on. But if we were to do some really broad brushstrokes, generally speaking, we could sketch out a spectrum of lease types broken out by the various names of the leases and show graphically, as we do here, the spectrum of the discrete cost responsibility to the tenant given the nature of that lease. Down the left-hand side here, we have a partial listing of expenses. Operating and maintenance naturally is an umbrella term, covers a whole lot of individual line items. And then we show some of those line items broken out specifically below. Real estate taxes are sometimes lumped in with operating and maintenance. Other times they are categorized and treated separately. Electric, cleaning, utilities, insurance, and then roof and structure. So if we start over at the left-hand side here with a triple net lease or NNN, we see that basically the tenant here has this discrete, explicit responsibility for all of these costs. And so typically A triple net lease will be in a retail context, and especially if it's a single tenant building, such as a standalone physical property like a Walgreens or CVS. And so basically, this is as simple as being a landlord can be, where basically you sign a lease with the tenant, and the tenant is going to be billed directly by the jurisdiction for taxes, by the utilities for electric, and will even take care of costs related to the roof and the structure itself. And so this is as clean as it gets in terms of being a landlord. Unfortunately, there is this whole other end of the spectrum and the gradations within that where things get murkier and are specific to a particular property, specific to a particular landlord, asset class, geography, so on and so forth. And so as we move across, we can see as we go to double net, this would be basically identical to a triple net lease in terms of discrete cost responsibilities to the tenant. But assuming you have a multi-tenant property, such as a strip plaza, the roof and structure would not be in a double net situation, be a responsibility discretely to that individual tenant. Okay, we can move across again to a net lease. This is where just operating and maintenance and real estate taxes will be discretely broken out and either reimbursed by or billed directly to the tenant. And then move across once again to modified gross. And this is a version of a gross lease, which we'll talk about in a second, where electric and cleaning are discretely broken out and billed to the tenant. A gross lease is sometimes the same exact meaning and structure as a full service lease, or FS. And other times a gross lease will be identical in all areas except that the gross lease will not require reimbursement of electric, whereas a full service will. Again, this is very broad brush strokes. There are a lot of nuances and a lot of exceptions, and every lease needs to be treated as its own contract, which it is, and needs to be understood with its own specifics. So let's go ahead to the Excel now and flip to the Landlord Point of View tab, and this is labeled LLPOV and Primary Inputs tab. Formatting wise, everything that you see here that is in this bold blue type is an input. And so this is something that would be intended to be changed and modified by the user, the operator of the model. And everything else is a calculation-based output, whether black or red, or simply a label. The inputs, as we can see, are all consolidated here within columns B through G. And what I'm going to do is step through each of the inputs and each of the line items, and we'll talk about what is happening here in the model. This model is set up just as a heads up to address three different lease types: a triple net, which we talked about, gross, and full service. And should you want to make further modifications to address a different type of lease, you can of course do that if you wish, because the file is unlocked. But these are three good examples to use for the sake of understanding. Again, this is from the landlord perspective. We're going to show the dollars in the context of the landlord's point of view. So rents we're going to be treating as positive. And by contrast, when we get to the tenant point of view tab, we'll see a lot more red, because we'll show dollar amounts and cash flows from the tenant's perspective. So the rent in that case will be negative. I'm back on the landlord tab now, and so let's go ahead and say, all right, I'm a landlord and here's a company that's interested in the space. This is the suite 2100 that we're talking about. It's 5,000 rentable square feet, and we assume for the sake of the analysis that it's going to be a 4-year lease. And this analysis only deals with a single initial term. It can in fact go out through 10 years, but I'm just showing it with a shorter duration here for the sake of the exercise. Let's say that this tenant needs 2 spots for every 1,000 rentable square feet. That would be 2 times the 5,000, gives us 10 parking spots that would go along with their space. And let's say that the monthly rent per parking spot is $125. And so let's assume, for the sake of this exercise initially, that the lease type is full service. If you click on the arrow next to that cell G12, you'll see there are other choices that we can select. But let's go ahead and leave it on full service for now, and we'll circle back later to see how it changes when we select other lease types. Let's assume we give 13 months of free rent, which translates to 1.08 years, and the tenant improvement allowance that we are offering as a landlord is $10 a foot or $50,000. And let's just assume there's some other concession or collection of concessions that are going to sum to $5,000 given an assumption of roughly $1 per square foot. So that's the basic setup. Just to be clear, when I click over to the Tenant tab, all of these items here are no longer in blue because I've simply brought them over from the Landlord tab. Some of them I've retained the calculations, but most of them I've simply wired in from the Landlord tab. And so if we want to make changes to the tenant elements here, we will actually need to do them on the landlord space, and it would make sense because for these items they're one and the same. Okay, the space is the same size to both, and the lease term is the same size to both, and so on. So moving down into the model here, what we do is we first look at the various categories of income and expense to us as landlord and look at those in the base year or the very first 12 months of the lease. And so we'll make some inputs relative to the base year going down the line here. And then next what we'll do is we'll look at how those elements will grow over time, over multi-period projection. And we see the projection fans out to the right here starting in column J, and we'll look at all those formulas to see how those grow these base values. Let's say that the going rent for a space of this type in this particular building is $57 per square foot per year. This is a very healthy rent, something that we would see in downtown Washington, D.C. or midtown Manhattan currently. So it's a desirable space that's being used as our example here. So that's $57. In this case, we said that the rent for the parking would be 10 spots at $125 per month per spot. And so that would be additional rent that we get, which is driven naturally by the rent input that we have there. If there's some storage rent, we could input that. Let's just leave that at 0 for the sake of keeping things simple. And the next line that we show here is a service charge line. This is something which is going to be based off of the lease type that we are currently displaying in the model. And so what we're showing here is full service. And so the formula that sits in cell E24 says the following. It says if the lease type is equal to B51, which is triple net as our lease type, then go ahead and sum the 3 base year expense and real estate taxes and electricity amounts, otherwise return a 0. Okay, and so basically what we're saying in the case of full service, there is no service charge or reimbursement to us as landlord because presumably those expenses are going to be baked into that asking rent already. Our economics as a landlord don't change given the lease type. We have certain costs which we're going to be bearing. And if they're going to be reimbursed, then the rent can be lower and that reimbursement amount is received in the form of a service charge. If they're not going to be reimbursed, then we will simply bake those costs into the asking rent, and then we will pay those expenses directly to the various service providers. In the case of a retail space, you might have additional rent in the form of percentage rent. We do include that here. It's negligible in this case, but we will show you how that can layer into the income to the landlord and the rent paid by the tenant. And so if we add all of this up here in the base year, meaning year 1 of the lease, on a per square foot basis as landlord, we will receive a total of roughly $60 per square foot. But as we said in the slides, as landlord, we have cash costs related to the space, whether it's occupied and cash flowing to us or not. And so we have some understanding, an idea of what these expenses are given the operating history of the property. And so what we'll do is we'll put in some assumptions here for $10 per square foot per year of operating and maintenance, an additional $5 for real estate taxes, and we break out electricity here separate from the operating and maintenance such that we can discretely model a gross lease. And so when we deduct that sum from our $60 a foot, the annual lease income net of expenses is $42. And so that's per square foot. If we want to see it in whole dollars, if we prefer to think of it in that way, we can simply multiply that $42 a foot by the 5,000. And so this is going to tell us this space, after we've paid all of the expenses that we have to pay related to the space, this space is going to generate pre-income tax roughly $210,000 a year for us. And if we want to look at it monthly, we can divide by 12 and see that. And so that's the basic setup. But there are some other elements that we cannot overlook that impact cash to us as landlord and are a reality in terms of getting the space leased up to the right tenant at the right rent for the right term, etc. And so there might be free rent, which we did say there was. In fact, we said there was going to be 13 months of free rent. So for the base year, if we have 13 months of free rent, this is going to have to be charged against what we said we were in fact getting, which we're not getting in the first year if the first year's full 12 months are being abated. And so what we do here then is we take the lesser of the product of the number of months and 12, because the base year only has a maximum of 12 months, times that base year rent, and we divide by 12. And so this is going to say we have $57, which we are in fact not getting. So this is not coming to us in cash flow because we made a deal with the tenant to say that they don't have to pay rent in the first 13 months. Additionally, we take a charge for the tenant improvement allowance, which we promised to pay towards the purpose of building out the tenant space. Leasing commissions. In this case, I don't show anything, but let's say we have $15,000 in leasing commissions. Okay, that too will need to be counted in as a cash adjustment to us as landlord in year one. And the other landlord concession we said was $1 per square foot. So in reality, the base year is a year of, in essence, investment for us. We're investing in this space for the subsequent future cash flows from this tenant. And so these are your basic economics for year one. Naturally, you don't have free rent every year. You don't pay TIs every year, nor leasing commissions, nor other concessions. So the net result is eventually going to be positive and grow over time. And so that growth is addressed here with our escalation inputs. For base rent, what we assume here is some average amount exclusive of any step amounts. Okay, and this is because this is a back of the envelope calculator. We want to keep things simple and fluid. So let's just say on a blended basis, it's 2%. Maybe if you wanted to blend in a $3 bump in year 5 or something of that nature, you could blend that up to 2.25%. But frankly, in this case, because we only have 4 years, you probably wouldn't have a bump anyway. So that's an assumption which is then going to flow through to our projections. So we see in year 1, 57 is the 57. Okay, the nominal amount is the real amount. But in year 2, we will grow that $57 per square foot by that 2% one time. We grow it one time in year 2 and 2 times to year 3 and so on. And so we see our base rent trending up over the course of the lease term. Likewise for the parking rent, we have an escalation factor there. If we had storage and we had an escalation there, that would also be reflected. And if there were to be a service charge, the service charge is simply going to reflect whatever the dollar expense amounts are. And so those dollar expense amounts are going to be driven off of their own escalation, so we don't need to have a separate dedicated escalation factor for the service charge itself. For percentage rent, we'll look at that in a moment. That's simply going to scale based off of the break point and the growth rate that's assumed on gross sales year over year. And so we have growth rates or escalation factors for the income side of the equation, and unfortunately we also have to have growth rates for the operating expense side of the equation because we live in an inflationary environment. It's reality. And so naturally each of these is going to impact its own line item projections as we track across over the term of the lease. And so this is all going to be reflected in our projection. Okay, and so if we take a look at our projection here, we see our base rents trending up over time, parking, okay, and then we get to service charge. Service charge here might not look all that correct. Say, well, hang on a second. I thought that we had something like $18 a foot in expenses, which is what I'm showing here. I'm carrying that as a landlord. Why do I have, first of all, no service charge in year one, and then in subsequent years it's under $1 or under $2 in case of year four? What's going on? Well, this is the result of the nature of a full service lease, which takes reimbursements in a very particular manner. And so if we look at the definition that we've included here in the comment box, this is generally speaking how a full service lease will work. The tenant reimburses, therefore we as landlord will receive reimbursement for all operating and real estate taxes and electric, but only for those amounts in excess of the base year amount. Okay, thus in the base year there are no reimbursements from the tenant at all. So again, while there was $18 here per square foot in cost to us as the landlord, we get nothing in terms of service charge. And so we can see here that our toggle is impacting what's happening here, and the logic is reflecting the lease type. But in year two, we do start to see a reimbursement, even though it looks minimal. And so what this is representing is the difference between what the base year operating expenses were of $18 a foot and what the year two operating expenses are in reality, which is $18.49 a foot. Okay, and so the net of those two is 49 cents a foot. And so it's that amount, and that amount only, in the case of a full service lease, that we would be reimbursed. And so again, as we said, because we have these expenses and they are significant, okay, think about a 1 million square foot building and a large lease within that building. These are very significant. These are going to be baked into that asking rent. And again, we see this trending up over time. Now, before we go too much further, should I change the lease type in G12 to triple net, okay, I'm going to see a distinct difference in the service charge line, in that there will be a perfect match between the service charge and the operating expense amounts, okay, and it will grow over time. Okay, so we saw in full service this was 0. Now this at triple net went to be 18 to match the 18 of cost, and 1849 to match the 1849 of cost. Okay, now as a result, what would happen is the base rent amount would come down probably by something like $18 a foot. When we say, well, what's the full service rent, or what would it be if it were to be triple net? Well, it would essentially be reduced as a triple net asking rent by the amount that is the total of the expenses, generally speaking. So we did triple net, we did full service. If we do gross, gross is slightly different from full service in that what we exclude is reimbursement of electric, because as we said, we are defining the gross lease type as all operating and real estate taxes being reimbursed except electric. Okay, and so if we toggle back and forth between gross and full service and we watch, right, we watch our service charge line here, we'll see that it changes ever so slightly starting in year 2, simply differing by the amount of the electric reimbursement. When we take a look at our projection and look at these year one or base year dollar amounts, we see this was our net cash flow or the investment year for us as landlord. And then as we go forward, we simply take the net of that annual lease income net of expenses and then any other cash impacts on a going forward basis. Because we did have 1 month in year two, remember we had 13 months of free rent, we did have 1 month in year two, this free rent does flow through here, so there is a slight deduction, but then going forward, the dollar amounts are a match to those in row 30. If we take a look at it on a cash flow basis, okay, this is the net cash flow per square foot to us as landlord. Okay, what is it to the tenant? Well, the tenant, we'll take a look at it in a second, but this is mostly due to their contribution towards their fit out of their unit. And then these are their dollar amounts that are coming out of their pocket to occupy that space. And the difference here, which you might guess and recognize, is going to be, okay, the difference in the amount that sums from the operating expenses in each year. A quick sidebar on the percentage rent. In the case of a retail lease, if it's percentage rent and we had a gross sales amount assumed from the space of $300,000 gross receipts for the year, and the break point or the threshold above which we as landlord would be able to take some share of gross receipts is simply equal to the base rent amount of that year, then there's going to be some dollar amount that we stated here was 3% that will come to us as landlord as additional rent. Okay, and so this is coming from these differentials in each year, and we have put in an assumed growth factor of these sales year over year. Okay, if sales were to be flat, then that would remain the same in each year, but we would assume some growth naturally, typically. So let me go ahead and just zoom out here. This is landlord perspective, and now let's switch over to the tenant and see what differs. Okay, so now I'm on the tenant point of view tab, and let's step through the inputs here. There are far fewer inputs on this tab because, as I said, most everything is being fed from the landlord tab. Okay, so the area, the lease term, parking rate, lease type, and so on, this is all being driven by what's on the landlord tab already. There's nothing really to talk about here. But the first item that's slightly different is, well, what are the project costs? Okay, we saw on the slide that white vanilla space. Okay, well, there was really nothing there. Okay, some tenants might think that that's cool and that's what they want. That's the look they're going for. Others might want hardwood floors, carpeting, millwork, and so on and so forth. And so they're going to have some, as a tenant, they're going to have something in mind with respect to the fit out, the scope of work required for the fit out of that space. Okay, and so let's say that as tenant, now we have our tenant hat on, we talk to our architect and space planner and interior designer, and we have come up with a budget of $15 a foot times that 5,000 square feet, and this is what we think it's going to take, $75,000, to get this space to the place where we are going to be comfortable and ready to accept it and move in and get to work. So naturally this is an input, and this can be changed, and sensitivity analyses can be run around that input. And so it's against that $15 a foot budget that we as tenant will negotiate to get the tenant improvement allowance from the landlord. And all these parts work together, where you have the lease term, the asking rent, the TI allowance, the escalations, the reimbursements. It's all one big cocktail of negotiations. Nothing exists within a vacuum. Well, let's take a look at the base year dynamics from the tenant point of view. Okay, we had a $57 base rent, which was a positive value when we showed it on the landlord tab, and now we're showing it as negative to reflect that from the tenant's point of view, it's a cash outflow. Okay. And then a parking rent amount, storage rent was nothing. Percentage rent is driving from the calculations we just saw. And so this would be the total rent, which is matching to the $60 a foot that we had on the landlord side. Now, if this is full service, there are going to be zeros here for the expenses that we are discretely bearing as tenant. Okay, we're bearing them in essence through the sizing of that base rent amount. We are bearing those expenses, but we're not discretely being asked to reimburse line by line for them, nor are we being billed directly for them in the case of this assumed full service lease. Okay, and so these formulas here are basically saying if this value, the lease type, is equal to triple net, then go ahead and populate these base year amounts in here. But otherwise, don't. Okay, so let me just go to the landlord tab for 1 second and I'll change it to triple net. And now when I go back to the tenant tab, I see I do have values, in fact, that have populated here. Okay, but I'm going to undo that just to keep a consistent analysis going for a full service situation. So the annual occupancy costs, okay, not lease income from the tenant's point of view, but rather occupancy costs per square foot are going to be that $60 a foot in the base year. But we do remember that we negotiated as tenant to get those 13 months of free rent. So in reality, it's not going to be $60 a square foot in cash that's coming out of pocket for us as tenant. It's going to be something significantly less in the base year. And so what we do is we adjust for the free rent, for the tenant improvement allowance, which counts against our project costs, and also adjust for any concession dollars. So for us as tenant in year one, we only have to come out of pocket $7 a square foot. That's great for us in the first year because it keeps our cash flow available for our operating business. We note that the difference here in row 37 is that whereas on the landlord tab we held the leasing commissions here, as tenant this is not a cost to us and we substitute instead the project costs. And so when we take a look at the projection here, it's very similar to exactly what we had for the landlord, except a lot of these values are negative now because what we're showing is cost to us as tenant from our perspective. And we don't show any service charge here because we simply reflect any amounts of the expenses that we will in fact have to bear given, okay, the assumed lease type. And so again, assuming it's full service, which it's currently set to be, in year one we don't bear any of these expenses as tenant, but in subsequent years we do bear those incremental amounts above and beyond the base year amounts, which we show over here. And we remember to be $18 per square foot per year in the base year. And so when we travel down, we have our annual occupancy costs. These are the cash costs, okay, coming out to us. But again, when we make the adjustments for free rent and so on, we will see that to us as tenant, our out of pocket, okay, this doesn't include any moving costs, but to occupy the space, exclusive of moving costs, exclusive of any prior lease termination fees, cancellation fees, etc., it's pretty inexpensive for us to get into that new space. But in the subsequent years, naturally, where the free rent has burned off, we have a pretty sizable rent to pay in absolute dollars in each year. Okay, and so when we compare the two on a net cash flow per square foot basis, okay, here's our $7 a foot in year one as tenant, and then these amounts in the subsequent years. The landlord, okay, they had a big expense in year one in order to get us in, and these are the dollars that they see on a net basis after they pay expenses, and the difference, once again, between these two, given a full service lease assumption, is the sum of all of those operating expenses. And so this is once through this analysis from both perspectives, and again, where you're going to make your inputs primarily is here on the Landlord tab, and we can look at different durations and see the graph changing in real time, enter in different rents, look at things on a different lease type basis, different growth rates, and so on and so forth. And so this is a very useful, quick tool that you can put to work and see things pretty quickly in terms of, does something look attractive to me from whichever perspective I'm considering, or regardless of the side that I'm on, I can also evaluate it from the other person's point of view and use that to inform my negotiations with them to make sure that what I'm proposing or what I'm fighting back on is going to be reasonable for them and something they would consider seriously as opposed to something they wouldn't. One other thing that I want to point out here is we do show on an average annual basis, okay, the amounts for each of these line items. Okay, this is your base year. We had our individual years out to the right. If you want to look at it on an average basis to understand things such as the net effective rent here, we have performed all these calculations here, which basically blend it down given the assumed lease term and the growth rates and all the other inputs that we have made. And we do the same on the tenant point of view, where we get to a net effective rent with and without percentage rent. So hope that this template is useful to you. We do have some significantly more powerful tools that are available for sale. These are the professional versions of the landlord leasing analysis and the professional version of the tenant analysis. And I'll give you a peek here at what this model does that makes it even more powerful and precise than the back of the envelope. And so we have here the exciting thing about this model is it does a comparative analysis across 3 offers. So here's our summary tab, which compares those 3 offers side by side to one another and shows them graphically. And then the individual lease offer analyses, this is the landlord model. Okay, this model is more precise in that it's monthly in nature, and it will address all of the nuances that we purposefully chose to gloss over in the back of the envelope for the sake of keeping it simple and manageable, such as, okay, we can escalate rents both by percentage and step factor using the 2 different columns here for growth rates. And then we have annual summaries. This lease analysis goes out for 25 years. And we have the brains of the model down below, which show on a monthly basis, okay, all of the cash flows on a monthly basis. This is an extremely powerful, sophisticated model. The coding here is quite extensive in order to achieve this level of precision. And we do also run an analysis here that assumes, okay, this is the landlord point of view, this assumes a cancellation. The professional tenant perspective model is just as robust and just as useful. Again, it's monthly in nature and allows for all of the nuances, the different lease types and cancellation analyses, assuming that free rent is included in any penalties and legal fees or not. If the penalty on a cancellation is based off of a percentage rate or a dollar amount. And again, it's monthly in nature, and has these terrific annual summaries. In addition, a rent versus own analysis. Okay, and so this is an excellent analysis if you are taking a look at these two options. Well, maybe I'll rent the space and use the cash that I would otherwise use to buy the space or buy the building and put that into my business, okay, versus owning the building or the premises or the retail condo or the office condo or whatever the case may be. And so that's a bonus rent versus own analysis that is included in the Tenant model. Learn more about this model and over 24 others at getrefm.com.